Welcome back to Trader UK, the money management channel. Today I'm back with a full portfolio update as it has been one whole year since I started investing in the stock market. So today I want to take a look at the portfolio as it stands and see if it has actually outperformed the market. To do that, I'm going to use the S&P 500 as the benchmark and we'll compare the results between the two to see if a newbie investor can actually beat this market. Before we do get going today, as always, if I can ask you to smash the like button for me, it's going to help me get the video out in front of as many people as possible. And of course, if you do enjoy the video, make sure you subscribe for more similar content. Now, I do remember a year ago when I first started investing, coming across that recommendation from Warren Buffett that new investors should generally stick with an S&P 500 tracker rather than picking their own stocks, as in general, this tends to yield a better return. So I guess today is my opportunity to see if I should have taken that advice or if I was right to go it alone. As we take a look at this, you'll see that I actually have two portfolios, one with Trading 212, which tends to be more tech heavy, and then one with the Gyro, which has ended up being more pharmaceutical and travel companies. There isn't actually any real reason for this, and it certainly isn't a hard and fast rule. You'll notice as I move through the portfolios, there's a few duplicated positions and a few that don't really belong in that particular portfolio. It's just how they've developed over time as my investing preferences have changed. First up here, we're going to take a look at the Trading 212 portfolio, which I'm bringing up on screen. This account has actually only been open for 4 months. The S&P 500 as our benchmark is up 7.1% across the same period. I have 18 open positions here in this portfolio. Some of these are up, some of them are down. So rather than going into great detail about how much I own and how much profit or loss I've made, you should be able to see that on screen for yourself. I'm just going to tell you my quick opinion on each of these, whether I'm looking to add more, at what price, and for that particular stock, how long I'm planning to hold it for. First up on screen, we have Abbott Laboratories. I'm going to hold this for 3 or 6 months. It's a very small position. Their rapid COVID test is going to be in high demand and no doubt it's going to be used across the airline industry, events industries to get the world moving again. I'm not going to add to this position. In fact, it's been flat the whole time that I've owned it. It's not a company I have a great deal of interest in, hence the tiny position. Then we have Alphabet. I will be holding on to this indefinitely because it's such a great company, but I'm going to keep a very close eye on what's going on with all the pressure on big tech at the moment. They're getting a lot of censorship and fair competition rules. I will add to this position if I get the chance, but when I get the chance to average down, so it needs to drop about 5% or so for me to do that. Then we have Amazon, one of my absolute favourite companies, but again, another victim of competition rules. The EU actually are really out to get them at the moment, but that's not going to change the fact that they are seeing huge growth and people will continue to use them. In particular, I've said this before, across the Christmas period, they're going to do very well. I want more Amazon stock. Anytime I see this under or around $3,000 a share, just know that I'm buying more. We also have Apple in here. They started making their own chips now, I think, for their Mac computers. They're diversifying their business away from the iPhones really well. And their iPhone sales should get a good boost from 5G, even though they had a bad quarter because of the delay releasing the new models. I'm going to be holding them again indefinitely. It's a great company. And potentially I would buy more if the price drops anywhere around $105 per share. Beyond Meat. Now, I actually prefer Kellogg's. If you've watched my Beyond Meat analysis, I much prefer Kellogg's as a way to capture the plant-based meat movement that's going on. The only reason I purchased this small position in this company was because when I did that video, the price dropped about 25% afterwards. I said I didn't really like Beyond Meat. I preferred Kellogg's. Almost immediately, in a couple of weeks, the price dropped 25%. So I thought it was a bit of a steal at that, but that just goes to show, because you can see here, the price can always go down lower. So I'm going to hold on to this for a few years. It's a breakout company. I'm interested to see what they do, but I would add to this position if the stock goes near $100, which is actually a possibility given they had such a bad quarter. If it gets near 100, I might add a little bit more in here. Then we got Facebook, another great company. I always worry about Facebook in particular with the way that they block election campaign ads. I wonder how the new president is going to take to them, whether it'll be favourable or not. But again, at the end of the day, they're still a money machine and I'll be holding them indefinitely. I would add more to this position again if the price gets near 260 per share. We also have an iShares, just a FTSE tracker here. This may get a boost actually if the UK agrees a trade deal with the EU before the end of the year, which I still think is actually quite likely. People say otherwise. I think it will happen. I'm not going to be adding any more to this, and I will probably offload it at some point next year, depending on how the recovery to the economy goes in the UK. An iShares Global Clean Energy Tracker. This is just a good industry to track. And apart from Tesla, I don't really own any companies that harness that clean energy movement. So it's an industry that I like to be involved with. I won't be adding any more though, and I'll be holding this one long term. JD Wetherspoons, great company, an absolute profit machine this one. It actually took multiple lockdowns and curfews and all sorts to force them into their first ever loss. My position here is big enough, but there is definitely still value in this one. In particular, if you see it have a couple of red days, because it just had a bit of a bounce back on the vaccine news, the recovery for this company is just beginning, but definitely value in Wetherspoons. Then we got Jet2. You're going to see this one again in my DeGiro portfolio. It's one of my biggest positions, one of my favourite companies as well. I'm very exposed to Jet2. I'm not going to be adding any more, but there are, again, very good value in this company and better value as things get moving as well. I'm going to be holding this until 2022, 2023, until they have fully recovered and swallowed up a lot of the Thomas Cook customers from when Thomas Cook went under. Ocado Group, I'm always talking about this one, absolutely great company. I'm backing them again to have a very, very big Christmas. I like their partnership with Marks and Spencer's. I think Ocado have a lot more to gain from that partnership than Marks and Spencer's potentially do. And I actually added to this position today. In fact, anytime I see this in the red, I'm normally adding more. I'm going to be holding this indefinitely. Again, I like the company. The closer this gets to £20 per share, the more you'll know that I'm buying. I also have Pinterest in here now. I like this as an alternative to the big social media players. They seem to be monetizing their platform really well without interfering with the user experience. And again, anywhere near $50 a share, I'll be adding more and holding them long term. Revolve. Now, this is a company that I'm 50-50 about. I'm not too sure with this one. They may or may not have a good Christmas period, given that they sell high-end products online. So online kind of suits them with a lot of places going into lockdown and people being worried about going out. But high-end, I'm not so sure how well that's going to fare in the economy that's probably going to be with us for 2 to 3 years from now. So it's 50-50 for this company. I won't add more, but I'll probably hold this until the end of the first quarter in 2021 before I offload it. Rolls-Royce here as well. Now this was an absolute long shot because the price was so beaten down, but they performed well on the vaccine news, of course. I can't see them going under, but they won't be the company that they were before this pandemic. Still, it's a good buy and hold for me at this price, and just hold on to it for a couple of years. Tesla, I will always love Tesla. I still love Tesla. I don't really think the stock price is going to do much until we move into 2021. But every time I see it, I'm adding a little bit more into the portfolio. Under $400 is a great price for me. In fact, I added to this position today when it dropped just below. Then we have TUI, another of my big positions. Again, I hold more in my second portfolio. It's still at a good price for me. I think there's value in this company. If you get a couple of red days, then I'll be buying in. I think they'll bounce back pretty quickly, actually, not to the levels we saw them at pre-pandemic, but summer 2021 should be good, providing things go well with the vaccine, etc. I'm not going to be buying any more because I'm so exposed already, and I already own a lot of Jet2, but I would be buying if I didn't already have these positions here on the next red day. I have a small position in Twitter as well. I don't like that they're really struggling with their active user numbers. They're growing, but they're growing very slowly, and for a growth company like this, it's not ideal. So I'm probably going to wait until the end of the first quarter in 2021, and then I'm going to offload this, but you can see it's a very small position anyway. Walgreens Boots Alliance. Now, I'm not in this for the long term. I just think I got a good price on this one. They face too much competition long term from Amazon, but I'm going to be holding on to this probably until the end of 2021, when they should be back to business as usual or as normal. I will not be adding more to this position though. So overall, you can see that this portfolio is actually up 7.5% across the past 4 months. If we compare that to the S&P 500, which is up 7.1% in the same time period, then it's pretty consistent with what the market's been doing. But next, I want to move on to my higher risk portfolio, my DeGiro portfolio here. Remember, this one is made up more of pharma companies and travel companies, most of which are recovery stocks in here. So although the companies still aren't actually performing well, they're mostly UK companies and the UK's in a lockdown at the moment, the prices that I got them at were really, really good. So we're starting to get a good return here. First up here, 3M. I don't see any value in this company. I'm going to offload this company within the next 6 months maximum, maybe sooner. Carnival Corp, my first of the cruise lines. I'm in a lot of travel groups and I've never actually heard anyone saying that they don't want to cruise anymore. I see a lot of people complaining that they can't cruise at the moment. So I think there's going to be a lot of pent-up demand. Again, my exposure to the travel industry is big enough, so I'm happy with my position at the moment. But I do think there's value here. I do think they'll survive, and I do think they'll do well on the other side of this. I'm going to be holding these well into 2022 and then maybe beyond that as well. Coca-Cola here as well. I don't actually expect too much from this position. I wouldn't be buying in now unless you're really into your dividend stocks. I'm probably going to offload this again in the next 6 months or so. GSK next, GlaxoSmithKline, not my best purchase. I still believe I got these at a good enough price that I can make a profit on them, but it's not going to be until late 2021. I will not be buying more, but I will hold on to them for now. Then you can see Jet2 in this portfolio again. You can see this is going to add up to one of my biggest positions and the biggest gains as well, because I got these at such a good price. J&J or Johnson & Johnson, it's the same as GlaxoSmithKline really. Hold them until the end of 2021 and hopefully offload them at a profit, but I will not be adding to that position. Marston's Brewery we have here as well. Not my favourite investment that I've made. It's very turbulent, this stock price. I'll probably hold on to it. They've got a good partnership with Carlsberg going on. I'll keep it until mid-2022, but I will not be buying anymore. Too risky at this price. Norwegian, second of the cruise lines, just like Carnival, hold until 2022 and possibly beyond that as well. Although I do think Norwegian, of the cruise lines that I hold, is the highest bankruptcy risk. So if I was picking one, it probably wouldn't be them. But yes, for now, I'll hold on. I just won't be buying anymore. On the beach, not a huge position here, but another in the travel industry. I'm actually less inclined to hold on to this company now, so I'm going to give them until the end of 2021, and then they'll be out of the portfolio. Roche, I want rid of this position by the middle of 2021. I wouldn't recommend buying any now. I certainly won't be. Royal Caribbean, again, hold till 2022 like the others, and then reevaluate along with Carnival and Norwegian. TUI AG, another big holding in this portfolio, so again, one of my biggest positions that I hold. And Whitbread as well. Now, of all the travel and hospitality stocks I own, and there are a lot, this is probably the one that I'm most unsure of. A big part of their business model is the Premier Inn brand. I know they've raised capital to expand that brand within Germany and throughout Europe, but business travel has seen such a fundamental shift since the beginning of this pandemic. I would hope they would rethink that. Otherwise, they could struggle if they do try to push ahead with that. I'm not going to be adding to this position, and I'll probably try and get rid of it, or at least some of it, by the end of 2021. And finally, we have EasyJet. I like EasyJet. I'm going to hold on to this for a couple of years at least, but again, I've got a lot of exposure to a risky industry, so I will not be adding any more. Now, this portfolio here on screen has been opened for the full year, in which time the S&P 500 has grown around 11%. Incredibly though, you can see here, this portfolio is up over 40% as it stands today. I'm sure it's in for a rough ride over the next few months, but this is well positioned for a good year next year in 2021 as well. So I'm very happy with this portfolio. So to answer the question, can a newbie investor beat the market? The answer is yes in this case. Just remember though, if you're not outperforming the market, there's also a lot of knowledge and experience to be taken from picking your own stock. So I wouldn't trade it all in just to track the S&P 500. If you do have questions about any of the positions that I hold in the portfolio or my general outlook, let me know down in the comments. As always, thank you very much for watching, and I'll see you next time.